Erin, I'll start with you. This was a very busy week. The markets were not always clear about what they thought. What did you make of what happened over the course of the week, and particularly those jobs numbers?
I think that the jobs numbers came well above consensus expectations and certainly underpin the fact that the economy is not in a recession right now, that job growth still remains quite strong and the labor market is still quite tight. And it probably also underscores the fact that the Fed has more work to do with respect to keeping rates in restrictive territory. The Fed has already indicated that they'll likely hike in at least an additional one time in March. And then after that, I think, certainly there's scope for the Fed to potentially hike an additional one time or pause there. But in either case, the Fed will likely not cut rates for an extended period, continue to remain restrictive for quite some time, and then really observe and see how the data unfolds from there. And so while the market has been romancing this idea of the Federal Reserve starting to cut at the tail end of 2023, the Federal Reserve, at least for now, is likely to continue to keep rates on hold for an extended period of time and not meet the market's expectations for rate hikes as soon as the market is expecting.
Bob?
Yeah, David, I wasn't confused at all. Actually, for the first time, I think the Federal Reserve and the labor data confirmed what the average investor, the average consumer is seeing. The Federal Reserve could have walked in and said inflation is nowhere near our target. We've got to raise rates indefinitely and push Fed rates expectations much higher, maybe the terminal rate to 5.5%, even 5.75%. Instead, they came in and said what I see, which is inflation is moderating. We can see an end to rate hikes. They confirm that. You look at the jobs data, and yes, it was a very big number, but how many times have we been here and we've said, everywhere we go in the services economy, there's a shortage of worker. You look at airports, you look at restaurants, they're complaining about not being able to hire enough workers. And this confirmed that. This labor report confirmed that the economy has shifted consumption from work from home sort of expenditures to things that are more services, travel, and leisure.
Well, I understand that. We've all been to restaurants and there's nobody to wait on you and things like that. But can we keep up this pace, Bob? I mean, this is a torrid pace. 500,000 jobs a month? How long can we keep this up?
Well, the data could have been very encouraging for the Fed because it shows they're meeting their dual mandate, right? Strong economy, full labor market, and inflation. You saw wages come down a little bit. The rate of wages is up 4.4 versus 4.8. But I think the market's right. I think the market's telling us you don't have 3.4% unemployment and wages stay stable. You're going to create wage pressure, which is going to create a lasting inflation problem.
Erin, what about that? Because that's one of the things that struck everybody, that you added so many jobs, got tighter and tighter in the labor market. At the same time, actually, the wages came down a little bit. Where is the wage pressure, and is it coming, and when?
Well, I think part of it is a mix shift issue, and we know that average hourly earnings does have some distortions with respect to the mix shift. And so looking at ECI, Atlanta wage data, is probably more appropriate indicators. That said, I do think that there is continued pressure, particularly on some of the services side, and particularly some of the areas that Bob mentioned with respect to leisure, travel, transportation, which saw some of the significant job gains this last month. That said, we are starting to see peak inflation on the wage side. We are starting to see measures of inflation start to move lower with respect to wage growth. And I think that that's likely to continue as we move through, the course of 2023. We'll still see wage gains, but at a slower pace. And I think that's what the Fed is really keyed in on in terms of, setting and determining their policy. If they continue to see wage growth move lower, which we're starting to see, that will allow the Fed to eventually back off and really pause. And So I think that's what the key thing to watch is the pace of wage gains, which is slowing from here.
So Erin, pick up on that very point, because I think most people agree, certainly Jay Powell said, we're starting to see some disinflationary forces. We're starting to see some of the inflation come off. But there's a question about whether that's going to continue, as you suggested, or whether you're really going to be able to get it down to anything like 2% without a lot more increases on the Fed.
So I don't think the Fed is likely to hike rates, significantly higher than here. I think one additional 25 basis point hike, or potentially two, is probably the most that's in the cards for the Fed at this time. And then they're going to sit and wait. And, we all know that Federal Reserve policy, moves with variable and lagged effects. And so I still think that the Fed thinks that the effects of the tightening last year will still continue to make their way through the economy this year, and therefore, there may not be future rate hikes that are necessary. But I think that they're willing to wait and see whether or not future rate hikes are necessary after another one or two hikes. And so, I do think that the Fed right now, does expect that they're at least not. There's not significantly more hikes that are necessary. And as a result of that, they're willing to take a little bit of a wait and see approach. That said, we have seen some disinflation. We'll likely see more, but to expect that we're going to move close to 2% by year end, I don't think many are expecting that. And I think that at this point the Fed will think of anything less than 3%. In terms of core PCE inflation is a win. So I think that's the number to be looking for, not 2%. It's really sub 3%.
Bob, one last one to you on this subject, and that is, what do you expect the Fed to do? And number two, what are the bond markets anticipating? Those could be two different things.
Well, we expect.
I think they are two different things. Sorry. Go ahead.
Go ahead.
So I agree with Erin. The Fed is setting us up to do one or two more rate hikes. And as she said, they pause, they wait for the cumulative and lag effects to hit. Our analysis shows that from the last rate hike until recession, it's roughly a year. So you're going to have to wait out several quarters to see, are you going to have that mythical soft landing, or are you headed into recession? The market is starting to front run that. We've all done the work. We know at the time of the Fed's last rate hike, that's the peak in yields, and things rally like crazy, particularly the front end of the yield curve. That's what we're seeing in bond markets. Absent today, we think that's what we're going to see going forward.
Erin, is that where you are?
I think that's right. I do think that the Fed has, or I think the market rather has front-run the Fed with respect to its expectations for rate cuts. And I think that the market rather is likely to be disappointed with respect to how quickly the Fed actually cuts rates. I think that just given the fact that inflation is going to be persistently higher and stickier than what the market's anticipating, that we're not going to see the extent of rate cuts, happen as quickly as the market wants. And so I think the market's setting itself up for disappointment. And I do think ultimately, the Federal Reserve will create a minor recession in the U.S. and that will take down equity markets and sort of higher risky asset classes. But I think in the interim, between now and when there's, a recession starts, the markets can do okay. It is, a little bit of a rally everything environment. But once the recession hits, that's certainly good for fixed income, but is not going to be as good for equity. So in that instance, I'd rather be a buyer of fixed income, which can rally as we sort of romance disinflation and can also rally into a recession, whereas equities will only do well, in this disinflationary environment, but not do as well once the recession hits.